In this video, we're going to dive into the strategies that can 10x your money and set you on the path to financial success. If you've got $5,000 in your bank account, this video is for you. So let's get started and turn that $5,000 into a launch pad for your financial future. Strategy number 1, understand your savings. Understanding how to save effectively is still a crucial foundation for building wealth. The key is to save smart. First things first. Let's bust a myth. Your savings account is not your ticket to wealth. Unlike what your parents or grandparents might have experienced, you can't simply save your way to riches anymore because of our old enemy, inflation. Inflation is like a silent thief, slowly eroding the purchasing power of your money. If your savings account is offering a measly 0.01% interest rate, and many do, you're actually losing money in real terms as inflation outpaces your returns. So the first solution is to establish an emergency fund. At the bare minimum, aim for $2,000. This is your financial safety net. It's there to catch you if your car breaks down, your AC goes out, or any other unexpected expense pops up. Having this buffer prevents you from going into debt when life throws you a curveball. Once you've got that initial $2,000, your next goal is to save between 3 to 12 months of living expenses. This range depends on your personal risk tolerance. If you're in a stable job and feel secure, you might be comfortable with just 3 months. If you prefer more security or work in a volatile industry, aim for closer to 12 months. Let's break this down with an example. Say your monthly expenses, rent, groceries, utilities, car payment, etc., total $4,000. In this case, your savings goal might look like having a minimum of $12,000, which covers 3 months of expenses, and a maximum of $48,000, which covers 12 months of expenses. Remember, this is money you don't touch unless there's a genuine financial emergency. It's your financial fortress, protecting you from life's unexpected turns. Beyond your emergency fund, the only other reason to keep money in savings are for upcoming big purchases or for short-term investment opportunities you're still researching. Consider moving some of your savings to an online high-yield savings account. These often offer much better interest rates than traditional banks. We're talking potentially 2% or more annually instead of 0.01%. It might not sound like much, but it can make a significant difference over time, especially when you're dealing with larger sums. Strategy number 2, pay down debt. Let's talk about something that might seem counterintuitive when you're trying to grow your wealth, paying down debt. But trust me, this strategy can be a game changer for your financial future. Here's a scenario I see all too often. Someone has a decent chunk of change in their savings account, but they're also carrying high-interest credit card debt. It might feel good to see that money in your account, but if you're paying 20% interest on your credit card balance, you're actually losing money overall. Imagine you have $5,000 in savings account earning 0.5% interest annually, which is actually pretty good for a standard savings account these days. At the same time, you're carrying $5,000 in credit card debt at 20% APR. Over the course of a year, your savings earn you $25 in interest, while your credit card debt costs you $1,000 in interest. See, the problem is that you're essentially paying $975 for the privilege of keeping that money in your savings account. Doesn't make financial sense. So here's what I want you to do. Once you have your emergency fund set up, use any extra cash to pay down high-interest debt. Start with the highest interest rates first. Typically, this means credit cards. Paying off a credit card with a 20% interest rate is like getting a guaranteed 20% return on your money. You won't find that kind of return in the stock market or real estate. Every debt you pay off is one less monthly payment you have to worry about. It's one step closer to financial independence. And let me tell you, the peace of mind that comes with being debt-free is priceless. By focusing on paying down your debt and avoiding new unnecessary debt, you're setting yourself up for long-term financial success. You're freeing up your future income to work for you instead of paying for past purchases. Strategy number 3, invest wisely. Remember how we talked about inflation eating away at your savings? Well, investing is how you combat that. When you invest wisely, your money has the potential to grow faster than inflation, meaning you're actually increasing your wealth in real terms. Now, I know, investing can seem intimidating if you're new to it. There are stocks, bonds, real estate, cryptocurrencies. It can all feel overwhelming. But don't worry, we're going to break it down. The key to successful investing is understanding the difference between investing and trading. Let's clarify. Trading is short-term. It's about trying to make quick profits by buying low and selling high in a short time frame. It's exciting, but also risky, and for most people, it's more akin to gambling than investing. Investing, on the other hand, is about the long game. It's about putting your money into assets that you believe will increase in value over time. We're talking years or even decades here. So, how do you start investing? There are several options to consider. The stock market is often the first place people think of when it comes to investing. You can buy shares in individual companies or, better yet, invest in index funds or ETFs that give you exposure to a broad range of companies. Another option is real estate, which doesn't necessarily mean buying property outright, although it's an option if you have the capital. You can invest in real estate investment trusts, REITs, which allow you to invest in real estate markets with much less capital. Bonds are another investment avenue. They are generally considered lower risk than stocks, but also typically offer lower returns, making them a good way to diversify your portfolio. Lastly, if your employer offers a 401k with matching, that's essentially free money, so make sure you're taking full advantage of it. Let me give you an example. Suppose you invest $5,000 and manage to get an average annual return of 7%, which is conservative for long-term stock market returns. Do you know how much you'd have if you didn't touch that money for 30 years? Over $38,000. That's the power of compound interest. But here's where it gets really exciting. Instead of just investing that initial $5,000, you add $100 every month. After 30 years, you'd have over $162,000. And remember, that's with a conservative 7% return. Strategy number 4, protect your assets. Now that we've talked about growing your wealth, it's time to discuss something equally important, protecting it. After all, what's the point of building wealth if you can't keep it safe? This is where real estate planning and insurance come into play. Let's start with estate planning. Now you might be thinking, I only have $5,000. Why do I need an estate plan? Well, remember, we're not just planning for today. We're planning for your financial future. As your wealth grows, having a plan in place becomes increasingly important. Estate planning is essentially deciding what happens to your assets after you pass away. Without a plan, the government decides for you, and trust me, that's not what you want. A few key elements of estate planning include the will, trust, power of attorney, and healthcare directive. A will is a legal document that specifies how you want your assets distributed after your death. Even if you don't have much now, creating a will is a good habit to get into. As your wealth grows, you might want to consider setting up a trust. This can help your assets avoid probate, a lengthy and often expensive legal process, and can provide more control over how and when your assets are distributed. A power of attorney designates someone to make financial decisions on your behalf if you're unable to do so. Similarly, a healthcare directive designates someone to make medical decisions for you if you're unable to make them yourself. Now, I'm not a lawyer, and the specifics of estate planning can vary depending on your situation and location. That's why it's a good idea to consult with an estate planning attorney or use a reputable online service to create these documents. Moving on to insurance. This is your financial safety net. It's a small price you pay now to protect against potentially huge costs in the future. You may want to consider health insurance, auto insurance, homeowners insurance, renter's insurance, or life insurance. For most young, healthy adults, a term life insurance policy is usually sufficient. The general rule of thumb is to have coverage that's 10 to 15 times your annual income. So if you make $50,000 a year, you'd want a policy with a death benefit of $500,000 to $750,000. It might seem expensive, but the term life insurance is usually much more affordable than people think. A healthy 30-year-old might be able to get a $500,000 20-year term policy for less than $30 a month. That's less than $1 a day for the peace of mind knowing your loved ones would be financially protected if something happened to you. The goal of insurance isn't to make you rich. It's to prevent you from becoming poor due to unforeseen circumstances. It's about protecting your wealth you're working so hard to build. Strategy number 5. Invest in your education. Many people have a misconception about education. They think that once they're out of school, their learning days are over. But the truth is that if you want to build serious wealth, your education should never stop. Continuous learning is one of the most common traits among successful people. Warren Buffett, one of the world's most successful investors, is said to spend 80% of his working day reading and thinking. Elon Musk taught himself rocket science by reading books. The point is that successful people never stop learning. Now you might be thinking, but how does this help me 10x my money? Well, think about it this way. Let's say you invest $1,000 in a course that teaches you skills to get a promotion or start a side hustle. If that leads to an extra $5,000 a year in income, you're more than 10x your investment in just the first year. But here's where you need to be careful. The internet is full of get-rich-quick schemes and overpriced courses promising unrealistic results. Let me give you a personal example. A few years ago, I invested about $2,000 in a digital marketing course. It wasn't easy to part with that money, but I saw it as an investment in myself. That course taught me skills that I've used to grow this YouTube channel and my other online businesses. The return on that investment has been exponential, far more than I could have earned by simply putting that $2,000 in the stock market. Now, I'm not saying you need to go out and spend thousands on courses. Start small. Maybe it's buying a few books on personal finance or investing. Maybe it's taking a free online course to learn a new skill. The key is to start somewhere and make learning a habit. Here's a challenge for you. Commit to investing at least 1 hour a day in learning something that can help you earn more money. Could be reading a book, watching educational videos, or taking an online course. Do this consistently for a year, and I guarantee you'll see results. So, what's your next move? Which of these strategies are you going to implement first? Let me know in the comments below, and don't forget to subscribe.